We usually like the financial physics of the market to make sense, right?
Right. Yeah, like Newtonian physics.
Exactly. Every action should have an equal and opposite reaction. You post a massive top-line beat, you raise your forward guidance, you show like this explosion in free cash flow, and the stock price goes up.
It's supposed to be binary.
It's supposed to be logical. But if you look at the landscape for early 2026, that whole system is just completely broken.
Oh, completely. The disconnect is wild right now.
So today on Talk Techers, our mission is to figure out why. We are taking a deep dive into Rubriks Q4 and full fiscal year 2026 earnings call, which happened on March 12th. And we're basically looking at a massive fundamental beat and raise quarter colliding head on with an incredibly weak, cautiously skeptical software tape.
Yeah, it is the absolute definition of a disjointed market reaction. I mean, you have this infrastructure entity executing at, honestly, the highest possible level internally. They're completely remodeling their gross margin profile, and yet they are swimming in this macroeconomic fishbowl that is just terrified of software multiples right now.
The gravity of the broader market is just overpowering the individual asset.
Exactly. The macro is dragging down the micro.
Well, let's start by defining the actual thrust of that asset, because the numbers here are staggering. I want to give you, the listener, a rapid-fire snapshot of the results first. So GAAP earnings per share came in at a net loss of 43 cents.
Which, to be fair, is a solid improvement.
Right. It was a 61-cent loss a year ago. But the non-GAAP EPS, which strips out all that stock-based comp and one-time stuff, that actually hit a positive 4 cents.
Which absolutely crushed the street consensus. I mean, analysts were modeling an 11-cent loss.
A 15-cent beat on the bottom line is not something you see every day.
No, it's really rare.
And top line, revenue came in at $377.7 million. That's up 46% year over year, beating consensus by over 35 million.
We really have to pause on that 46% figure for a second.
Yeah, it's massive.
Because at a nearly $400 million quarterly run rate, maintaining mid-40s percentage growth it's mathematically grueling.
Right. The law of large numbers usually kicks in.
Exactly. It points to a go-to-market motion that has fully moved beyond, early adopter evangelism. They are in a phase of structural, mandatory enterprise deployment now.
But despite all of those blowout numbers, the immediate market reaction was just a total head fake.
Oh, it was brutal to watch.
Shares spiked to around 54.50 early the next morning in pre-market, and then the opening bell rang, and it completely faded with the broader market.
Just gave it all back.
Closed down 1.09% at 53.43. And this wasn't light volume either. We're talking 9.8 million shares traded.
Yeah, compared to their usual, 3.2 million daily average?
Exactly. So the critical question we want to answer for you today is this. When a company reports hypergrowth metrics and record cash flow, but the market actively sells the news, is the asset being wildly mispriced? Or is the market seeing some macro ceiling that the fundamentals just haven't hit yet?
Well, I mean, the market is essentially imposing a sector-wide tax right now. Institutional capital is seeing the execution, they see the cash flow, but they are structurally de-rating the entire software cohort.
Guilt by association.
Precisely. Individual excellence is just being overshadowed by collective anxiety about valuations.
I want to shelf the market psychology for a minute, though. We will definitely get to the options data and the trading dynamics later, but we need to unpack the actual cash generation and operating leverage first.
Because the core financials are spectacular.
They really are. If you just strip away the ticker symbol, this is a pristine quarter. Subscription annual recurring revenue, ARR, reached $1.46 billion. That's up 34% year over year.
And their net new subscription ARR hit an all-time record, right?
Yep, 115 million in a single quarter.
But the composition of that ARR is what actually matters. Their cloud ARR is now sitting at $1.29 billion.
Wow.
Yeah, that represents 88% of their total subscription ARR. And that specific cloud cohort is growing at 48% year over year.
So they are effectively at the tail end of their cloud transition.
Exactly. And if you look at the history of companies like Adobe or Autodesk, the transition from legacy on-prem licenses to cloud subscriptions is historically the most treacherous period for any software company's income statement.
Right. The valley of death.
Yes, the valley of death. But Rubrik has seemingly navigated it and come out the other side intact.
They navigated it while actually expanding margins, which kind of defies standard SaaS logic.
Yeah.
Non-GAAP gross margin expanded to 83.7%, up from 80% a year ago.
That's a huge jump for gross margin.
And it is. But here is the number from the earnings call that actually made me stop and reread the transcript. Free cash flow for Q4 was $70.1 million.
Yeah, that's strong.
And for the full fiscal year 2026, it was $237.8 million.
Wait, 237 million?
Yes. That is more than a 10x improvement from fiscal year 2025.
That is insane.
Right. I mean, a 10x jump in free cash flow in 1 year in enterprise software usually sets off alarm bells for me.
Yeah, you have to ask if they're playing games with working capital.
Exactly. Are they pulling forward multi-year contract payments to juice the statement, or is this organic?
It's a totally valid skepticism. When cash flow multiples outpace revenue growth that aggressively, you have to dig into it. But in this case, management highlighted a very specific accounting dynamic, the material rights treatment.
ASC 606 revenue recognition stuff. It can be so opaque. Let's get into the weeds on that. What is a material right actually doing to their top line?
So, under standard accounting rules, when an enterprise customer signs a contract that includes an option to purchase future goods or services at a significant discount.
A discount they wouldn't get otherwise.
Right, a discount tied specifically to that foundational contract. When that happens, the company cannot recognize all the cash they collect up front as immediate revenue.
Because they haven't delivered the future service yet.
Exactly. They are required to defer a portion of it, and they only recognize it when those future rights are exercised.
So it's essentially a deferred revenue release mechanism tied to modernizing their installed base.
That's a perfect way to put it. As Rubriks' legacy customers transition from old on-prem architectures to the new cloud environment, these material rights are triggered and recognized.
Got it.
And in Q4, that specific accounting dynamic contributed roughly $18 million to the total revenue.
Okay, wait. If that $18 million is effectively a byproduct of accounting rules catching up to previous sales motions, does that mean the Q4 beat was just an accounting artifact?
That was the exact question the analysts were pushing on during the call. But management clarified that even if you completely strip out that $18 million benefit, the normalized, purely organic revenue growth was still 43%.
Oh, wow. So the fundamental demand is completely real.
Very real. And that brings us back to the cash flow. The subscription ARR contribution margin improved by roughly 950 basis points year over year.
950 BPS. That puts them at what, 12% over the trailing 12 months?
Yep, 12%, which means for every incremental dollar of new subscription revenue they close, it costs them significantly less in sales, marketing, and onboarding to actually acquire it.
The mathematical proof that their sales engine is running with way less friction.
Exactly. They aren't just running faster, they're running way more efficiently.
And the customer cohort data backs that up entirely. They didn't just pad the top line with small mid-market deals. They added 32 net new customers with over $1 million in ARR.
32 whales in a 90-day window.
Yeah. And the 100K plus cohort grew 25% to 2,805 total customers. I have to ask, how rare is this specific financial profile right now?
Extremely rare.
Right. To grow the top line at over 40%, expand gross margins by 300 basis points, multiply free cash flow by 10, and land $32 million whales. I mean, most software companies right now are forced to choose between growth and profitability.
They are. The macro environment usually dictates a brutal trade-off. You either protect your margins by gutting your sales and marketing spend,
which tanks your net new AR.
Exactly. Or you brute force top-line growth by spending aggressively on customer acquisition, which incinerates your free cash flow. Achieving both simultaneously suggests that the underlying product has crossed a major threshold. It's gone from being a useful utility to critical infrastructure.
It tells us their sales reps aren't discounting heavily to win competitive bake-offs. They have real pricing power.
Which leads us to the strategy behind that pricing power. How are they ripping out legacy incumbents to fuel this?
Well, reading through the call transcript, it's clear this is no longer a conversation about just modern backup.
Yeah.
Right? They have fundamentally expanded their identity.
Yeah, the pivot from backup and recovery to cyber resilience is the core narrative here. And the market share data shows that pivot is really resonating with chief information security officers.
Management explicitly stated their win rates against legacy data protection vendors were north of 90% in Q4.
I mean, north of 90% isn't a competitive market anymore.
No, that's a structural displacement.
Right.
If a legacy incumbent enters a procurement cycle against Rubrik right now, they have a less than 10% chance of keeping their own client.
Yeah.
Why is the gap that wide?
Because the legacy architecture was built for a threat landscape that basically doesn't exist anymore. Legacy backup was designed to protect against hardware failure, like a server crashing or a flood hitting a data center.
Natural disasters, yeah.
Right. But Rubrik is architected to protect against active, intelligent cyber warfare. And you can see it in the numbers. Over 45% of their subscription net retention rate came from add-on security products.
Up from 34% a year ago.
Exactly. Customers aren't just buying storage space anymore. They're buying the security layers bolted onto that storage.
And the most explosive growth vector within that security portfolio is their identity line of business. They crossed 900 customers in the identity segment this quarter.
Up from just 400 in Q3, right?
Yeah, they more than doubled that specific customer base in 3 months. Plus, they just launched Okta Recovery, adding to their existing Active Directory and Microsoft Entra ID protection.
We really need to unpack why identity is suddenly the most critical real estate in cybersecurity.
Yeah, let's do that. Because if you look at the major breaches over the last 24 months, like the scattered spider attacks targeting massive casinos and tech companies.
Threat actors are rarely brute forcing their way through firewalls anymore. It's just too difficult.
Too much friction.
Right. Instead, they are socially engineering or purchasing compromised credentials on the dark web. They're literally just logging in as authorized users.
It's the old security adage. Attackers don't break in, they log in.
Precisely. And the single point of failure for that entire ecosystem is the identity layer. Systems like Active Directory.
Which is essentially the passport control of a corporate network.
It's the central nervous system. It dictates who you are, what computer you can log into, and what files you have permission to read. If a ransomware operator manages to encrypt or corrupt Active Directory, the entire company just ceases to function.
The factory floor robotic arms shut down.
Yeah.
The hospital cannot route patient records. The trading desks go dark.
Everything stops.
And the case studies they detailed on the call illustrate exactly what happens when that nervous system is threatened. Let's dig into the 3 specific examples management provided.
Yeah, they map out the exact pain points driving this massive revenue.
First up, they talked about a Fortune 500 global hospitality company. They displaced both a deeply entrenched legacy provider and a separate cloud-native backup solution, choosing to deploy Rubrik as a single platform across their hybrid environments.
And management projected this will deliver multi-million-dollar savings just by eliminating redundant cloud-native backup costs.
That is a textbook consolidation play.
In a constrained capital environment, CFOs are ruthless about tool sprawl.
Oh, absolutely.
A hospitality company with global operations likely has, legacy mainframes in their older properties, VMware on-premises in their regional hubs, and cloud infrastructure in AWS or Azure for their consumer booking apps.
So historically, they would need 3 completely different vendors to protect those 3 environments.
Exactly. But by offering a unified control plane, Rubrik isn't just selling better technology, they are selling operational simplicity.
The second case study highlights a totally different catalyst, though: regulatory pressure. A European financial services firm replaced a multi-decade legacy incumbent specifically to meet DORA and ECB regulatory guidelines.
Right, DORA, the Digital Operational Resilience Act. It is fundamentally reshaping the European IT landscape right now.
It's a sweeping mandate from the EU, right?
Yeah.
Financial entities have to be able to withstand and recover from all types of IT disruptions.
Yes. But how does that differ from existing banking regulations? I mean, haven't banks always had disaster recovery plans?
They have, but historically a disaster recovery plan was like a dusty binder that got tested once a year over a weekend.
Right.
DORA changes the actual liability. It's no longer enough to just have backups. You have to mathematically prove to regulators that your recovery time objective, the exact number of hours it takes to restore your core banking systems from a total ransomware lockdown, is within strict, legally mandated limits.
And legacy systems just can't do that.
No. Systems relying on tape backups or fragmented disk arrays physically cannot restore petabytes of data fast enough to satisfy the European Central Bank. The architecture is just too slow.
So DORA is effectively forcing a mandatory continent-wide upgrade cycle.
And Rubrik is perfectly positioned to absorb all that capital expenditure. Which brings us to the third and frankly most alarming case study from the call.
The healthcare provider.
Yeah. A major U.S. healthcare provider adopted Rubrik's Identity Resilience Suite for over 10 petabytes of data. And by deploying this, they cut their Active Directory recovery time from over 30 days to under 4 hours.
That is wild, going from 30 days of total paralysis down to half a business day.
I want to understand the mechanics of that, though. Why would it normally take a hospital a month to restore their Active Directory?
Well, because recovering Active Directory isn't just about, restoring a file. It's about restoring a highly complex, interconnected database of trust. When a network is breached, the AD environment is fundamentally contaminated. If you just restore your AD from yesterday's backup, you are likely restoring the exact same vulnerabilities and compromised administrative accounts that the attacker used to get in the first place.
We're literally just reinfecting yourself.
Exactly. So the traditional recovery process involves building a completely clean, parallel environment, manually verifying thousands of user permissions, and painstakingly migrating the data over to ensure no malicious code hitches a ride.
Wow.
It is forensic, exhaustive work that takes weeks. And by the time you finish, the hospital has lost tens of millions in delayed billing, canceled procedures, not to mention the massive risk to patient care.
So how does Rubrik condense a 30-day forensic nightmare into 4 hours?
Through an immutable architecture. Management used the term doomsday bunker on the call.
Right, I saw that.
Rubrik creates a mathematically immutable append-only file system. Once data is written to it, it cannot be edited, encrypted, or deleted, not even by a user with stolen administrator credentials.
So when the hospital gets hit,
Rubrik provides an uncontaminated, instantly accessible version of the identity layer that completely bypasses the manual forensic rebuild.
that creates an incredible amount of pricing leverage. Which brings up an interesting point about their economic model. Unlike a lot of SaaS platforms that charge per seat or per employee, Rubrik largely prices based on data volume.
Right.
So if they own the data protection layer and the identity recovery layer, doesn't their billing model essentially act as a structural tax on the overall growth of enterprise data?
Yeah, it acts as an underlying index fund on data creation. I mean, they don't need their clients to hire more staff to expand their revenue footprint. They just need their clients to generate more logs, more records, and more code.
And the compounding rate of enterprise data creation is only accelerating.
And the undisputed catalyst for that accelerating data creation right now is obviously generative AI.
Exactly. Which transitions us into the most forward-looking, ambitious part of the transcript. Let's dig into AI governance, the agent cloud, and this fascinating sovereign cloud concept.
They are aggressively pitching this idea of becoming mission control for the AI enterprise.
This is where we shift from analyzing their past execution to modeling their future total addressable market. The big headline announcement was that Rubrik Agent Cloud is now generally available.
Integrating directly with Amazon Bedrock Agent Core and Microsoft Copilot Studio, right?
Yes. And we see AI injected into every single software earnings call right now, usually just as empty buzzword bingo.
Yeah.
But the mechanics of what they're building with Agent Cloud feel fundamentally different.
How so?
It's explicitly designed to monitor sanctioned AI agents, hunt down shadow IP AI agents, and apply real-time dynamic guardrails to stop hallucinations or compromise agents from executing catastrophic commands.
To appreciate the technical hurdle here, we really have to draw a hard line between an AI chatbot and an AI agent.
That's a great point.
A chatbot is a passive entity. You query it, it synthesizes information, and it returns text to your screen. The risk is limited to, basically, misinformation.
But an AI agent is an active entity.
Exactly. It is granted API keys. It has the authorization to take action autonomously. It has read and write access to your Salesforce database, your corporate email servers, your code repositories.
It has a corporate credit card and administrator privileges.
Right. Now, consider that attack surface. What happens if that agent hallucinates a command? Or, more likely, what happens if an external threat actor uses prompt injection to compromise that agent?
The damage isn't just a bad answer in a chat window.
No, the agent could autonomously email highly sensitive intellectual property to an external server or systematically delete a production database, executing millions of commands in milliseconds.
Management pointed out that while AI agents offer 100x more productivity, they introduce 100x more risk because they operate at machine speed, completely divorced from human oversight.
I love the analogy they used on the call for
The car analogy.
Yeah. They said you wouldn't build a car capable of going 200 miles an hour without simultaneously engineering an autonomous braking system and highly sophisticated lane assist guardrails.
The speed demands the control.
Exactly. And their recent acquisition of Predibase is the engine powering those brakes.
Predabase is the linchpin of this entire agent cloud strategy, right?
Oh, absolutely. Predabase specializes in low-latency LLM fine-tuning and inference. Rubrik didn't buy them for their revenue. They bought them for their architectural capability.
Because to dynamically govern agentic interactions, you can't rely on static, rule-based cybersecurity policies.
Right. If an agent is making thousands of autonomous decisions a second, a traditional firewall can't keep up. You need a specialized, fine-tuned AI model to monitor and throttle the behavior of other AI models in real time.
You can't bring a knife to a gunfight. That was the exact quote from Bipul Sinha on the call.
You need AI to watch AI.
But this raises a counter-argument that is terrifying a lot of software investors right now. There is this pervasive market fear regarding AI disruption. The anxiety that a hyper-intelligent foundational model could just write a few scripts and instantly replicate or replace existing software platforms.
Yeah, management pushed back on that thesis aggressively.
They had to, because it's the primary bear thesis for the entire sector right now. Why can't a future iteration of ChatGPT just wipe out Rubrik's code base?
The defense is rooted in the physical reality of enterprise infrastructure. Rubrik is not a thin front-end orchestration layer that can be easily spun up in a weekend hackathon.
Right.
They are a massive, hardware-optimized data infrastructure layer. They rely on 12 years of what management calls soaking time inside the most complex, disparate enterprise environments on the planet.
They are integrated into the bare metal storage arrays, the legacy mainframes, the intricate network topologies, and the identity providers.
You cannot prompt an LLM to hallucinate a system of record of last resort that natively understands the physical limitations of a hospital's on-premises hardware.
The moat is the sheer unglamorous complexity of the plumbing.
Exactly. The plumbing protects them.
I buy the infrastructure moat argument. But let me push you on the timeline here, because a massive TAM on a slide deck doesn't pay dividends today. When does this agent cloud actually materialize on the income statement?
That's the billion-dollar question.
Because if you parse the language on the call carefully, management openly admitted we're in the very early innings of this deployment.
And the timeline is critical for valuation. Right now, Agent Cloud is largely in the proof of concept and discovery phase with massive Fortune 500 companies.
So they aren't even monetizing the dynamic guardrails yet.
Not at scale. The initial motion isn't even about controlling agents yet. It's about helping companies simply discover the shadow IT agents that their developers have already secretly spun up.
Just finding the problem first.
Right. Meaningful monetization at scale, where this line item starts driving bottom line EPS, is likely a fiscal year 2027 or even fiscal year 2028 event.
It is a profound long-term catalyst, but it is not going to bail out next quarter's revenue.
No, it won't.
Which makes their broader macro positioning even more important to understand. We also need to look at the sovereign cloud discussions that surfaced on the call.
This is a fascinating architectural pivot.
It really is. Geopolitics are fundamentally driving nations to build digital embassies to ensure AI compute and corporate data remain strictly within their physical borders.
It represents a massive reversal of a decade-long trend. I mean, for years, the enterprise mandate was globalization lift and shift everything into massive, centralized hyperscaler data centers in Virginia or Ireland to capture economies of scale.
But rising geopolitical tensions combined with stringent data privacy laws have completely fractured that model.
Yes. Governments and highly regulated industries now demand data sovereignty. They want their data, and more importantly, the AI compute infrastructure analyzing that data to reside physically within their own borders.
Subject exclusively to their domestic legal frameworks.
Exactly. But building a sovereign cloud isn't just a matter of renting a local server rack.
Right. It requires incredibly complex cryptographic access controls, ensuring that not even the infrastructure provider, not even Rubrik themselves, can access the underlying data.
It's a net new market opportunity born out of political friction, and it perfectly aligns with their core competency. Securing data in hostile environments is literally what they do.
So to synthesize the narrative here, we have a high-growth fundamental setup today, a clear, logically sequenced AI product roadmap for tomorrow, and seamless operational transitions internally, highlighted by Jesse Green, stepping up to the Chief Revenue Officer role without missing a beat.
But a compelling narrative is just poetry until you subject it to the math.
Exactly. Let's look at the guidance. Does the FY 2027 outlook actually support the story they are telling?
Well, let's start with the near-term expectations. For Q1 of fiscal year 27, they guided for revenue between $365 million and $367 million.
with a non-GAAP EPS loss modeled between 4 and 2 cents.
But the full year guide is where the actual confidence of the management team is revealed.
Let's hear it.
The full year FY27 guide projects subscription ARR to land between $1.829 billion and $1.839 billion.
That implies 25 to 26% year-over-year growth.
Yep. Revenue is guided at roughly $1.6 billion at the midpoint. Free cash flow is expected to be incredibly robust, between $265 million and $275 million.
And critically, they expect non-GAAP EPS to turn structurally positive for the full year, coming in at a range of 7 to 27 cents.
I also noted in the transcript that management flagged hardware constraints as a potential macro risk.
Yeah, they specifically called out memory pricing, likely HBM and standard enterprise DRAM, impacting the cost of on-premises deployments.
But they quickly neutralized the comment, noting it hasn't had a material impact on their margins yet. How do you interpret the architecture of this guidance?
Honestly, it is a masterclass in expectation management. This is a highly disciplined, conservative guide from a veteran team that knows exactly how Wall Street models work.
You're setting themselves up to over-deliver.
Exactly. The Q1 guide purposefully factors in very tough year-over-year comparisons from a blowout quarter last year, but the full-year numbers model significant compounding operating leverage.
The fact that they are guiding to positive full-year EPS while sustaining over 25% ARR growth on a nearly $2 billion base prove they're not sacrificing their margin structure to buy scale.
And the hardware constraint comment is simply prudent hedging. They are acknowledging that the global physical supply chain for AI infrastructure is highly constrained by players like NVIDIA, but Rubriks software margins provide a massive shock absorber against hardware inflation.
It's also worth highlighting the absolute math of their ARR growth. The starting point for the FY27 net new ARR guide is actually stronger in pure absolute dollar terms than where they started last year.
Which is huge, because the law of large numbers dictates that as revenue scales, the percentage growth rate must inevitably decelerate. But their absolute dollar additions to the pipeline are actively accelerating.
Which is the holy grail of software valuation.
Okay, so we have thoroughly laid out the fundamental case. Management delivered an execution masterclass. The legacy displacement is real, the AI strategy is logically sound, the margins are expanding, and the guidance is disciplined.
So we return to our original problem.
Why did the stock performance look so incredibly anemic? Let's dive into the investor context and reconcile this highly bullish print with the cautiously skeptical price action that faded the gap up.
Well, to understand the psychology of the tape on earnings day, we have to look at the trailing performance going into the print. The chart has been brutal.
Over the 3 months leading up to the call, the stock was down 33.1%.
And over a one-year window, it was down 24.6%.
That is a massive underperformance relative to any benchmark you choose. Over that same trailing one-year window, the S&P 500 SPY ETF was up roughly 16.9%.
Even the cybersecurity sector ETF, the CIBR, which has had its own struggles, was only down 4.5%.
This specific asset was being systemically hammered going into earnings.
The disconnect between the business and the stock is starkly highlighted by the sell-side reaction. The fundamental analysts look at the cash flow models and they see immense value.
Right. Post-print, William Blair published a note stating the quarter was exceptionally strong, highlighting that the FY27 guidance came in above consensus across every single key metric.
Guggenheim maintained their buy rating and defended a $110 price target.
Wedbush maintained an outperform rating, though they did trim their target to 90 to reflect sector peer multiples.
So if the analysts are defending $90 to $110 targets based on the math, who is aggressively selling at 53?
Exactly. Why is the broader market rotating out of an asset with this much operational momentum?
Because the market is undergoing an indiscriminate structural rotation out of high multiple software stocks.
It is driven by two immense overlapping macroeconomic fears: AI disruption and cost of capital volatility.
There is a pervasive narrative among generalist fund managers that generative AI is going to commoditize software interfaces, drastically reducing the pricing power of SaaS companies across the board.
And simultaneously, the higher for longer interest rate regime continues to compress the valuation multiples that investors are mathematically willing to pay for future cash flows.
It is the ultimate manifestation of guilt by association. The market is treating the print as great fundamentals, terrible tape.
The debate on Wall Street is no longer about Rubriks' individual ability to execute. They prove that. The debate is whether any level of flawless execution can outrun a structurally deteriorated software multiple and a highly cautious institutional risk appetite.
And the options activity surrounding the earnings call paints a vivid picture of this exact battle between retail expectations and institutional mechanics.
The options chain data is wild. Going into the print, call option implied volatility absolutely exploded. Volume spiked 191% above the historical norm, hitting over 20,800 contracts.
You had a legion of retail and momentum traders looking at a severely beaten down chart, anticipating a blowout quarter, and aggressively buying short-term out-of-the-money calls, betting on a massive gap up.
They were betting on a return to the Newtonian physics we talked about earlier. Good print equals stock goes up.
Right, but the institutional tape sellers saw that exact same dynamic and used it as a liquidity event.
They absorbed all that retail demand, happily sold them the calls, collected the massive inflated premiums, and then systematically faded the stock right back to where it started by the closing bell the next day.
It was a textbook implied volatility crush.
We should probably explain the mechanics of an IV crush, because it's the hidden trapdoor of earnings trades.
Yeah, the price of an option is heavily dictated by a Greek metric called vega, which measures implied volatility. Before a binary event like an earnings call, uncertainty is at its absolute maximum, so implied volatility, and therefore the price of the options skyrockets.
The premium is artificially inflated by the anticipation of the unknown.
Exactly. But the second the earnings press release hits the wire, the binary event is over. The uncertainty instantly vanishes.
Even if the company reports spectacular numbers, the implied volatility collapses.
And when 5E collapses, the premium value of those options gets completely vaporized, even if the underlying stock price moves slightly in the right direction.
The fundamentals were a 10 out of 10, but the structural market mechanics squeezed the retail call buyers completely dry.
Which brings up a fascinating point about market efficiency. When you have a fundamental disconnect of this magnitude, a company growing ARR at north of 30% while throwing off hundreds of millions in cash, combined with heavily elevated implied volatility and an indiscriminate sector rotation, it creates mispricing.
It creates a dislocation between the intrinsic value of the cash flows and the assigned value of the equity.
And mispricing is exactly what we look for.
Which brings us to the segment where we transition from analysis to pure theory. Let's head to the whiteboard for a thought experiment.
I feel compelled to state very clearly, for the record, that what follows is purely for entertainment and theoretical discussion. We are analyzing structural market dynamics. This is absolutely, unequivocally not financial advice.
100%. We are simply looking at the structural setup we just spent the last 50 minutes unpacking and trying to build a logical framework around it. Let's structure an outrageous but plausible trade idea based entirely on this specific friction between internal execution and macro sentiment.
All right, what are we calling it?
I am calling this the execution outruns sentiment options collar and pairs trade.
The name alone requires a white paper. Walk me through the structural setup.
The setup relies entirely on exploiting the cognitive dissonance in the market. We know fundamentally that this company has roughly 25% guaranteed ARR growth locked in for the year, an exploding free cash flow profile, and a massive AI catalyst that begins hitting the income statement in late FY27.
But we also know the broader software tape is acting like an anchor tied to its ankles.
And crucially, we know short-term call option implied volatility just spiked 191% because retail traders keep trying to blindly pick the bottom.
So the objective is to exploit the high implied volatility without exposing the portfolio to the macro software malaise. How do you construct the legs?
We structure an options collar, but we manipulate the timeline to match the fundamental thesis. Step 1. You sell the heavily inflated, near-term, out-of-money calls.
You step in and capitalize on the retail traders who bought those 20,000 plus contracts, hoping for an immediate V-shaped post-earnings moonshot.
Exactly. You act as the casino. You collect that massive IV-inflated premium up front.
And you use that collected premium to finance alongside of the trade, effectively lowering your cost basis to zero.
Yes. You take that collected premium and you immediately buy long-dated, leads long-term equity anticipation securities. Specifically, you buy call options that expire deep into fiscal year 2027.
That is mathematically sound. You are getting paid today by impatient short-term money to finance a long-term position that perfectly aligns with the actual timeline of the agent cloud revenue hitting the P&L.
You are giving the fundamental thesis enough runway to eventually overwhelm the macro sentiment.
But that only solves the timeline issue. It doesn't solve the sector risk.
Here's where we make it a true hedge fund pairs trade. To hedge against the broader software sector experiencing further systemic multiple compression due to interest rates, we need a short leg.
Right.
We pair our long LAPS by shorting a basket of the very legacy on-premises data protection vendors that management explicitly stated they're displacing in 90% of their competitive takeoffs.
What is structurally elegant about that construction is that you achieve delta neutrality on the macro level.
Exactly. If the entire software sector gets crushed tomorrow because the Federal Reserve signals higher rates, or because the market panics about AI commoditization, your short basket of legacy vendors will crater, providing massive gains that offset any temporary weakness in your Rubrical EPS.
But fundamentally, over a 2-year horizon, you are structurally long the modern AI-resilient architecture and structurally short the decaying legacy architecture that is physically incapable of meeting DORA regulatory standards.
It effectively isolates the alpha. You remain immune to the macro software malaise in the short term. You profit from the impatience of short-term options traders via the IV crush, and you are perfectly positioned for the massive AI agent revenue cycle that will begin flowing through the income statement when your MIPS mature.
It perfectly captures the tension we've been discussing, the friction between long-term fundamental value creation and short-term market mechanics.
All right, let's pull all these threads together. We've covered the complex sauce accounting mechanics, the strategic pivot to cyber resilience, the terrifying reality of AI agents operating at machine speed, and the psychology of a broken tape.
Let's recap the core thesis.
This company just delivered an absolute masterclass in land and expand enterprise software. They are successfully transitioning from legacy backup utilities to comprehensive identity resilience, and now they are actively building the AI agent control plane of the future.
By every objective operational metric, ARR growth, margin expansion, free cash flow generation, they are doing exactly what they promised the market they would do.
But they are swimming upstream against a macroeconomic current that is indiscriminately punishing software multiples regardless of individual merit.
The central challenge for investors looking at this asset isn't predicting if the company will execute. The execution is a mathematical certainty at this point.
The challenge is predicting exactly when the broader market will care.
Which brings me back to the thought we started with about the physics of the market and how we value assets in a state of technological transition.
I want to leave you with a final provocative question to mull over as you digest this deep dive. We spent a lot of time discussing the doomsday bunker analogy.
And AI agents holding corporate API keys.
Right, operating at the speed of light. If management's thesis is correct, that generative AI increases enterprise cyber risk by a factor of 100, simply because an AI agent can execute malicious, catastrophic actions autonomously in a fraction of a second, are we currently drastically underpricing the insurance premium that global enterprises will be forced to pay infrastructure players?
It is a compelling macroeconomic framing. If AI adoption is an inevitable, mandatory economic imperative for corporate survival, then paying the AI resilience tax to secure that adoption is equally inevitable.
You cannot deploy the former without purchasing the latter.
So think about the implications of that. Think about what happens to the total addressable market of a company like Rubrik when compliance with that AI resilience tax stops being a recommended best practice discussed in boardrooms.
And becomes a literal, heavily enforced federal mandate.
When a product shifts from a nice-to-have efficiency tool to a strict regulatory requirement, the multiple the market is willing to pay expands violently.
That is the ultimate disconnect we are watching. A massive thank you to you for joining us on this deep dive. As a final reminder, everything discussed today is for informational and theoretical purposes only and should absolutely not be construed as financial advice.
We invite you to build out your own models, push back on the mechanics of our pairs trade thesis, and consider where the gravitational pull of the software market is heading next.
Keep looking past the tape and keep digging into the fundamentals. We'll see you next time on Talk Tickers.